right, we'll call our meeting to order for the Oklahoma City Post-Employment Benefits Trust for Monday, August 13th, 2018. The first item of business that we have is to approve the minutes from the May 14th meeting. Can I get a motion? All in favor? Aye. Any opposed? Motion passes. Next up is the presentation from Doug Anderson with ANCO. First, we have the presentation on the quarterly, and then we'll have we'll receive the monthly investment flash reports for May, June, and July. So I'll let you take those in whatever order you choose.
Sure. Well, thank you. Good morning, everyone. Why don't we start with the June 30 quarterly report? I think that's the best place to go, and then we'll talk about the July 31st flash report after that. I can ask you to open to page 2. Just give a broad overview of market performance during the quarter. On the upper right-hand side, you can see our favorite performance charts for equity markets. The red and the pink columns, those are international equities. You can see that they were down on the quarter. In fact, emerging markets are down 8% on the quarter. You can see that there's a real dispersion here. Domestic and international markets are in a divergent pattern, to say the least, right now. You can see that domestic equities were positive across the board, including a gain of almost 8% for small caps during the quarter. Now, one of the things that's magnifying the performance of the international equities for this period of time is the dollar is very, very strong. We are in a series of trade disputes right now, which we read about each and every day. Not sure how much is hyperbole and negotiating positions, but it is affecting fund flows for investors, and right now that's favoring U.S. equities. Something else that we saw change dramatically in the first half of this year is the performance of energy. Energy stocks, with the price of oil going higher, performed very, very well. And for U.S. investors, that was helpful, and we'll talk more about that in just a few moments. Looking down for the third set of columns there on the top chart are fixed income bonds. And you can see bond performance was marginal. 30-year Treasury remains around 3%. 10-year Treasury is moving slightly higher, and as we pay attention to the Federal Reserve, employment is very tight. We're under 4% unemployment in the United States, and that's of people actively seeking jobs. Growth during the second quarter of this year was above 4% in real terms, which is unusual. That's fairly high. But the Federal Reserve is indicating that they're going to raise rates 3 times this year, maybe even 4 times next year. The indication is that the U.S. economy, if you had to balance between the two, is probably closer to overheating than recession right now, and we're seeing that in the equity markets, and we're seeing that in the bond markets too. Now, overseas markets, slightly different picture. I do not think that China is going to see a hard landing or a hard recession right now, but these trade issues are definitely having worldwide effects. And if there's anything that tariffs and trade issues do, it's inflationary. Prices rise for everything, and that is something that we can deal with. And hopefully these are just negotiating positions and will be resolved soon. If we look down for the 1-year table below that for the same performance indicators for U.S. or for international equities, high single-digit returns, and those are great even after we've seen losses over the second quarter of this year. U.S. equities are very strong over that period of time, and they haven't necessarily gotten that much more expensive. What we've seen is earnings increase dramatically, and a big part of that, if we look at very recent earnings reports coming back out over the past 2 weeks, the corporate tax cut was significant, from 35% down to 21%. Corporate America is very lean right now, and they are very adept at adapting business models to changing tax regimes, and we've seen a significant positive impact because of that. We look at fixed income, moderately positive or slightly negative returns as interest rates have moved higher. The following pages are more in-depth performance. In the interest of time, I'll say that growth has outperformed value. Until recently, we've seen a hiccup there. I don't know if we've noticed the Facebook, Netflix earnings misses that happened just recently and punished those stocks. If we look down over the trailing 1 year, you can see that growth outperforming value by a fairly significant margin on page 3. For instance, on the small cap part of the marketplace, Russell 2000 growth was up 22%, Russell 2000 value up 13, still a nice return, but growth stocks have definitely outperformed. And please keep in mind, we are 10 years into an economic recovery. We are 10 years into a fairly shallow economic recovery, but this is not necessarily the time that we would see acceleration in growth and in corporate profits, but I think that this time is unusual. And with the tax relief and other issues that we've seen, we may be closer to an acceleration or inflation than a recession at this time. And it is unusual, and I think that we need to keep our forecasts and the way that we're thinking about this different this time as well. Look down at the following page on page 4. This is sector performance. Long story short, technology has done fantastically well over the past year. Energy has done extremely well over the past quarter, up 14% during the quarter, and that's as oil prices rise. If we go on to the following pages, international equity, higher risk emerging markets went down significantly more than developed markets. And as we go on to performance for the bond market, not a lot to see here. Interest rates have been stable to slightly higher, different parts of the curve. However, we can earn a yield of almost 1.5% keeping the money in cash. In many cases, I have clients saying, do we keep it in cash, excess funds in cash, or do we allocate to fixed income? And for me, if it's 6 months or less, maybe even a year or less, I would lean heavily towards the more certain return of cash rather than trying to take the round trip. If interest rates rise, you're going to have less money than you started out with, or 1.5% yield is starting to sway me towards lower risk investments on the fixed income side. Now, as we go on to page 10, the big green number, and this is for the 12 months ended June 30, fund is up 11.3%. It's a fantastic rate of return. I think that we saw a number of things change during the year, and the returns for the total trust were significant and very, very strong. We see on page 12 the progression of the total amount in the portfolio rising. You go back to 2009, we were relatively stable and low risk, but as you see over recent periods of time, that growth has accelerated. And it hasn't been a significant change in asset allocation on page 13. You can see over time, just recently a slight uptrend in equities, which we would expect. And this does not include the additional funds that are held in reserve outside of the trust and cash. And I think that's $7-ish million right now, which is a little higher than normal. But again, our alternatives are to potentially invest that into fixed income. And I'm not necessarily sure that's a safe place to be for the next 6 months. And I'll be talking with Bob and Matt about how to invest those funds going forward in the near future as we get past the period ending issues. You look at the total fund allocation on page 14. We're at $52.7 million, and again, all-time high. Looking at the allocation, 63% in domestic equity. We have 16% in core fixed income, 9.5% in international equity. Active duration bonds is 8%, and high-yield fixed income at 2.8%. This is a very long-term oriented portfolio. This is not something that is meant to minimize near-term volatility. It's meant to, I would say, be closer to maximizing long-term rates of return. With that percent in equities, and we talked about this significantly in asset allocation discussions, but you should expect some volatility in this portfolio given that we are almost 75% in equities.
Do you feel like we're getting to a place that with the growth that we've seen, that we're getting to a place to rebalance? The concern is right now, where do you rebalance?
Well, I think that rebalancing naturally occurs with this trust through the cash flow process. We'll go back to target at every time, and what that forces us to do is effectively buy low and sell high. And that's really, it's very mundane, right? But we want to make it systematic that when we do allocate or we need to pull funds, which is very rare, that we go back to target. And don't question that. I had a client last week. It's an interesting situation. It was a corporate pension fund, and as they get closer and closer to fully funded, they're supposed to take less risk in their portfolio, and it's well defined in investment policy what they're supposed to do. And so they just reached a funding threshold. So they went from 80% funded to 85% funded. And the trigger there was to take 7% from equities and reinvest it in fixed income. But they've been waiting for this for, I would say, 6 or 7 years for this to happen, and anticipating this over time. And then finally, at the meeting, I said it's time to take some profits and put back in fixed income. And they're like, wait, no. We're not quite ready to do that. And it's like, well, you're going to have to change policy. And again, we want to make it systematic that we're doing the right thing.
Right.
And they see equity markets being great, and they see fixed income as dull, but it's time, right? And that's what we want to get to. And it was an interesting discussion. In the end, the folks came around and said, this is policy. We did this in a very unemotional time. We kind of step back and say, hey, this is why we did this. And so that they are doing it, but it was an interesting perspective change that we have to guard against. And so those are the allocations. And you'll see that it doesn't change much over time. We have frequent enough cash flows that we're able to manage the allocation without being too intrusive, in my mind. Ooh, that's a good question. I can get you a ballpark figure. So the S&P 500 is 37% of the portfolio, and I'm wondering if you're bringing that up because Amazon is about to go into consumer discretionary. Yes. Well, sure. I did a full portfolio roll out. I don't think I did sector by sector, but if we go to, so consumer discretionary is, I would say, about 14% of the S&P 500, which is 37%, so we'll call that under 4. Their consumer discretionary of the Hotchkiss portfolio is, I'll call it 7. We're not significantly overweighted to it. That's a great question. Let me write that one down. And then as we go to page 15, you can see the market value broken up by a different way. This is by the individual funds that we're invested in. Largest one is the S&P 500, as it has been. Again, I think that's an effective way to get market exposure to a fairly efficient asset class. Stevens Small Cap Growth at 14.1% had excellent returns. You can see that it went from 6.7 up to $7.5 million during the quarter. As we look to the next investment, it's Causeway Capital, 9.5%. And as difficult it is to invest in international equities, I think we want to stay here right now. Causeway is a great contrarian manager. They're very systematic, and we like them. And it is, it's sort of a rule. If you're not underperforming somewhere in your portfolio, you're probably not properly diversified. Looking down this list, we have the two bond portfolios at $4.3 million each. We have the Hoisington active duration portfolio at $4.2 million. Hotchkiss mid-cap value at 3.3, Vanguard, the mid-cap index fund, at $3.2 million, and then our high-yield portfolio at $1.5 million. The cash here, again, does not include the cash reserve held outside of the trust. Looking at the market value change for the quarter, I really like this because it puts the numbers to a more tangible format for me. We started the quarter with $51 million. We had contributions of $1 million. We had distributions of $1 million. I think that's a cash flow netting. We had income. This is just interest and dividend income of $205,000. And our appreciation was $1.4 million during the quarter. And all of that, plus some, came from the equities. The bond portfolio was actually capital depreciation during the quarter. Bond prices go down as interest rates go higher, and that's what we saw there. Our strongest performer was Stevens, was up more than half of the total appreciation during the quarter. And remember, we've been very patient with that fund. It's not one that's performed well over all periods of time, and so we're glad to see that. I could ask you to turn to page 17. This is the total fund rate of return. So for the quarter, the total fund was at 3.07%, outperformed the policy index by a significant margin, outperformed our actuarial assumption, and the all public funds under $70 million median was 1.3%. So what you see there in the parentheses of 1 means you ranked in the top percentile of all funds in this peer universe for the period of time. So that's a fantastic result. We've been patient. We've been waiting. We've had a good long-term plan. It's just taken a little while for it to come through. For the one-year period of time, 11.26. Your policy index was up 9.15%. So again, a fantastic result there, ranked in the 4th percentile of the peer universe. For the last 3 years, you were at 7.63. Your policy index is fairly aggressive, right? It has a lot of equity in it. And over those last 3 years, we have had some underperformance, most notably in the Hotchkiss portfolio. But you still ranked in the 15th percentile. So over the last 3 years, we've seen some positive changes in momentum of the portfolio. We look over the 5-year and the 7-year period of time, and we are below the benchmark index for those periods of time. Thankfully, we're above the actuarial assumption on both of those. And remember, when we go back to the very early days of this portfolio, we carried much less risk than our index because we were fearful, and I think that fear was justified at the time. Didn't want to lose significant amount of initial capital in a highly volatile and uncertain marketplace, so we took less risk. But the last 3 years have seen a real turnaround. If we go down to, on page 18, at the total fund level, you can see over the last year, the calendar year was 16.7%, which was better than the policy index and much higher than the actuarial index. 2016, 8.42. In 2015, we sort of have some scars from that one, as we had some over-allocation of energy at the time, and both in the equity and the fixed income portfolio. So looking down the one-year return, if we can ask you to jump back to page 17, the one-year return for the total fund, 11.26. As we go down the list, Loomis Sales Bond was up 1.13. Its index was slightly negative, down 40 basis points. The double-line bond portfolio was up 0.73. Its index was down also. The Lord Abbett High Yield Bond Portfolio, again, these are high-yield fixed income, below investment grade, 2.58, which was slightly above its peer universe. Its benchmark index. Hoisington at 0.23 outperformed its index too. So when we look down at our fixed income portfolios for the last year, all of them outperformed their benchmark index. Looking down at the one-year result for the equity portfolios, we can see the S&P 500 is up 14.2. The mid-cap index was up 1197. Those are great rates of return, and again, fairly close to their benchmarks. Hotchkiss was up 14.5%. Its index was up 12.2. But the real star of the show was Stevens, up 30.15%. And that is 14% of the plan's assets after the most recent appreciation. So that's a fantastic rate of return. We have had to wait for a while for that to happen. And then as we go down to our international equity portfolio, 593 versus 737. A lot of financials in that portfolio, quite a bit of Europe within that portfolio, and some emerging markets as well. So I'm happy to take any questions about the overall top-down view of the portfolio. We're pleased. No major manager issues with any of them. The underperformance at Causeway is totally understandable. Our bond portfolio is working nicely together, and it's working nicely with the equity allocations as well.
Are there any questions on the quarterly report?
Actually, before we move on from that, I would like to go, I'm going to skip over the fund sheets. Those are there for you to look at as you want, but as we go on pages 40, if I could ask you to turn there. This is our manager status summary. I recommend no changes to this. I think Causeway's underperformance recently is understandable, but we're going to keep a focus on them, keep them on alert. As we go on to page 41, as fiduciaries, as we all are in this room, making sure that the costs are managed effectively here is very, very important. If we look down the list here, our index funds are inexpensive, but this is a changing marketplace. On our company firm-wide consultant call on Friday, I don't know if anybody saw the news last week, but Fidelity is saying that we will manage index funds for zero cost, and we're kind of getting to the bottom of that. Zero cost is not zero cost, but we feel obliged to take a look at that to make sure we know what's going on. I imagine that there's some sort of securities lending type issue, and you can only bring new assets into these accounts, and you probably have to custody them at Schwab. There's probably a lot of hoops to go through. But as fiduciaries, when somebody comes out and says we're going to do it for zero, probably not zero, but I want to understand what it is. So we're taking a look at that firm-wide. But as we look at the total management fee here, 52 basis points is the weighted average. The category weighted average is 87 basis points, so we're 35 basis points below category average as a total fund, and I think that's very, very attractive. Looking at the following page, you can see where we are overweight. You can see the Stevens portfolio is outside of policy, and we'll need to trim that back or add to other asset categories to get that within target range. But this is what happens when equity portfolios have good returns, really good returns. And we need to recognize that. So that is the full quarterly report.
All right.
Thank you.
Any questions on the quarterly report? All right, if you want to move into the flash reports.
So the July 31 is really the only one that we haven't covered yet, and that's in your board packet. If we look as of July 31, I think it's good to step back and just take a look at the market environment here, see where the returns have been so far this year. And if we look on that top line chart, the bumpy line chart there, looking at the returns, can you remember back to February when we actually had a market correction? I mean, and it was because came out of the bond market because we saw some inflation figures moving pretty high or pretty quickly in the U.S. market. But we have moved on from that bottom there. You see 4% down for the year, which was actually more than 10% decline peak to trough. And then for international equities, it's been sort of iffy, but U.S. equities have gone much, much higher over that period of time. And again, it's not because they're being pushed higher on speculative profits. U.S. economy and U.S. corporate sector is doing very well right now. So as we go down that table on the 2018 market monthly index performance comparison, the table just below that, U.S. equities had another strong month during July. Large caps were up 3.45, small caps up 174. Year to date, large caps are up 6.4%. This is 7/12 of the year. Small caps up 9.5%. Everything else is negative. Bonds are negative. International equities are negative. But again, no reason to make any major changes. And as we go down to the sector performance on a year-to-date basis, energy is up 8.84% for Russell 1000, Russell 2000 up 592. But again, healthcare and technology are big performers. But we're seeing, strong performance across the board, except for, consumer staples is tough and telecoms is a little bit tough right now. So going into page 1 of the report here, this is the flash report. Total fund getting close to $54 million. The allocation is not significantly changed. For the month, it was up 2.14%, slightly trailed the policy index. Hoisington was down during the month. You'll see that versus the benchmarks, the Hotchkiss & Wiley was up 1.03. Its index was up 249. Stevens, again, 232 versus 172. And over the past year, it's held up really nicely at 31.5%. These returns, like all of the returns, net of fees, net of management expenses, and all periods longer than 1 year are annualized. So you look at the 5-year return on Stevens at 10.7%. That's a very nice rate of return. It's really interesting. We're not going to, I think that the defining, if we have to inject politics into this right now, I think the defining factor is not midterm elections right now. I think that it's probably more the foreign policy issues that are affecting prices on a day-to-day basis. And normally you see something where midterm elections, especially first term, change of hands in the presidency, normally you see, the opposition party gain seats. But, as far as the polls are going, and they seem to be changing very, very quickly, directionally and in magnitude. So watching, yes. Changing investment philosophy, no. If anything, we're starting to see the profitability of corporate America, I think, is underreported. I think that the progress corporate America is making and how that's affecting tax revenues positively. I mean, I pay attention to our tax revenues in Tulsa and sales tax collections over here, and we're doing really well right now. And try to find a hotel room in Odessa or in Midland, Texas, or even the activity that's going on out here in Grady County. I mean, it's unusual. We're out of sync with the rest of the marketplace, but where the economy is strong, and I think it's the most underappreciated technology advancement that we've seen in the past 20 years, and that's the drilling technology and the geological technology that we've seen. I mean, everybody talks about Uber, everybody talks about, WeWork and that kind of stuff, but when we're talking about, the ability to extract minerals in a more factory or systematic process, whereas, 20 years ago we were wildcatting everywhere we went. But the recovery rates in the Permian and the Scoop and the Stack and the Merge and the Marcellus, it's absolutely amazing and completely ignored by most of the country.
All right, any questions on the flash reports? So I would take a motion to receive the monthly flash reports for May 31st, June 30th, and July 31st of 2018.
So moved.
All in favor? Aye. Any opposed? Motion passes. We don't have any issues on the discussion of any reallocations. So the next item that we have will be the interim financials. So thank you, Doug.
Thank you, Mr. Chairman.
Appreciate your work. Thank you. And we have Amy Lucas here from our Accounting Services Division that will present the financial report.
Good morning. How are you this morning? First, I want to say Jake is usually the one from accounting that serves as the one that does this report, but he's taken a promotion, and so he's not going to be with us doing Opebt any longer. And so from now on in the future, our new Opebt accountant is Rhonda, and so you will be seeing her face in the future as we go through these audited financials and update through the new year.
I thought maybe Craig had Jake removed because he couldn't pronounce his last name.
He didn't want to have to try to pronounce that name.
I got it right every other meeting at least. I mean, come on.
That's a tough one for sure. If you guys would first turn your attention to page 6, which is actually a statement of your changes in plan net position. We're going to look back over this preliminary data for the past year. I'm just going to kind of take it in order. If you look at the contributions for the year from 2017 to 2018, they're lower just a little bit. They went from $28 million to $27 million. And I would say the enrollment numbers that we have gotten from benefits are also down this year. You're not going to see that in this financial because we have not updated those numbers as of yet. They will be in your audited ones that we bring to you a little bit later. But the enrollment went from about 5,700 to about 5,500. So when you see those contributions going down, it probably has to do with that lower enrollment. Investment income has stayed pretty stable this year. It was about 5.14 last year for the total year, and this year it's at about 5.41, so a little bit better, but about stable. If you look at the deductions and you look at the benefits paid, it actually has gone down quite a bit, about $3 million. I think the main part of this is probably due to a change that we made in January on our prescription, the company that we were using for our prescription coverage for those under 64. We changed from what used to be Express Scripts, and now we're using Therapeutical. Yes, that's exactly how we're using. So I think there you see a large, I was going to say, I think you see a large savings in just the 6 months that we've done there that contributes to most of this.
I'm sorry, could you repeat that again?
How about I just let you say that?
A large savings due to the change.
Exactly. Yeah. And then the administrative expenses you see have gone down about $20,000 there. We paid our last year on the American tax credit tax that came through with that health care. This was our last year paying that on the numbers, and so that went way down this year, and we won't have any of that in the future for Opebt unless something changes. So if you look at the net position, which is what we're most interested in, it went up from $49.13 million to $58.98 million. So that was a great increase for the trust over this last year. Also, if you want to turn to the notes within your financials to page 10, it's kind of a brief overview of the investments. And I think usually Jake points out that if you look at our money market, we actually have 7.02 compared to 4.76, which is reported on the next page for this year, and that's the money that we have that we can use to pay claims with. So there's the money there. And then on page 12, this is where we show the asset allocation guidelines and what our minimum, target, and maximum are. And it's showing for our fixed income that we have an actual of about 24.2, which therefore is leaving about 75.8 for equities to spread that allocation and the investments over. That's a brief summary of where we've come in the year, and we're working on the final numbers for the auditors, and we hope to have those in the next couple months. Any questions?
Thank you, Amy.
Thank you.
Thank you.
I do have a question, I'm sorry. The funding of the liability, I believe I found it back here somewhere, 8.5%, we're funded 8.5%. Does that sound right to you, Craig?
I think the current report showed, I was thinking it was like 10 now, because we had been at 8.5%, but I was thinking with the increase in the net position.
That's what I was going to ask, and so.
Hold on just a second, because I read that earlier.
Well, while you guys are looking for that, I did have a question on page 6 in terms of the contributions. I noticed that the employer contribution is down a little, not quite $2 million.
Right. Why did I think that? Because the enrollment, that's based on, the contributions are based on the number that are enrolled in that, and it was down over 200 employees this year.
Okay.
But part of it, too, I think there was a change where we had been, funding more than the, it wasn't just the required contribution, but just the pay-as-you-go amount. We've been paying something over that, and during budget cuts, we had been trimming that back, and so I think that was part of that as well.
Okay.
I'll have to find that, Laura. I don't remember exactly where that was, but I read it this morning, and I thought it was saying that we were at 10.5. You guys don't remember where that is, do you?
That's what I was looking for off the top of my head.
Look at page 22.
Oh, wait a minute.
That top graph or top table shows total Opebt liability at $572 million, the net at $523, the plan net position percentage of total Opebt liability 8.58.
Yeah.
I am interested in knowing how that's changed, let's say, over the last few years. And I don't think that's in the report, so we might have to get that information at our next meeting.
I can do that.
And those on 22 would be based off of the 17 audit, right?
Yes.
So it's really a formal number that's stated after the audit's completed. But
Got it.
Right, we
there
haven't
was something that
received the new information for the current year yet.
Got it.
Right.
Okay.
So we'll make sure that we get that information, and I know that I read that this morning.
Well, I don't need to know it immediately.
Okay.
And,
Yeah.
if you're getting the information from the actuarial, I presume. then-
Yes, we hope to have our final numbers to them by Friday so that they can work up the new report.
So when that comes back to us, I'd be interested in seeing how that's changed over the last few years.
Okay?
Okay, sounds good. I'll mark
All
that
right.
down.
Thank
Thank you, Amy. Thank you, Rhonda. All right. I would take a motion then to approve or to accept the interim financial statements for the fiscal year ended June 30th, 2018. All in favor? Any opposed? Motion passes. The next item is to approve the external audit contract between the Opebt Trust and AGH. AGH is our auditor that we have for the rest of our city financials, and this is just the approval of the contract for this coming year. All in favor? Any opposed? Motion passes. Next item is to elect a vice chair of the trustees. Laura has served for the past few years as our vice chair and has served admirably as vice chair. So I would take any nomination on electing a new vice chair for this coming year.
I see no reason to change. I nominate Laura Johnson if she will accept that.
The best part about this is when he called me and asked me how I would feel about that, he promised to do everything in his power to make sure I never had to serve. I truly appreciate that.
Can I get a second? All in favor? Any opposed? All right, motion passes. Welcome back, Laura. Continuing your ride. Next item is to authorize travel expenses for trustees Carlton and Garrison to attend the Oklahoma Public Fund Trustees Education Conference.
Second.
All in favor?
And I just want to remark before we vote that how much I truly appreciate, as a future recipient of these benefits, I truly appreciate both of you being willing to become more educated about this, spending your personal time on this. It's a true service that you're providing to all of our retirees and future retirees, and I really appreciate that very much.
Police is hosting it this year. Is that right, Doug? Does that sound right?
I want to thank you for those kind words, and I've greatly enjoyed the prior conferences that I've gone to, and I do find it very beneficial, Neil. I think you'll benefit greatly. That having been said, my participation this year is iffy and will be for the next week or two. So if that's germane to the issue that you're going to be voting on, I cannot commit at this time.
So we'll approve it to authorize it, and that way if you are able to go, that way you can go ahead and attend.
Right.
So I take a motion?
I did move.
You did in second. All right. Then all in favor?
Aye.
Any opposed? Great. Motion passes. Next item is ratify the claims listing.
Second.
All in favor? Any opposed? Motion passes. Then reports and comments from trustees, staff, or interested parties. You guys have anything, Bob? Anyone on the board have anything?
The next meeting will be November 19th at 10 a.m.
At 10 a.m. we will meet at the next meeting, so we will make sure we get that posted correctly and that we meet at the correct time. So thank you all very much. We are adjourned.